Hey.
Magnificent.
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 The last episode taught us about the birth of Wall Street, a foundation that made everything possible, but it still had a lot of room to grow. By the early 1900s, the market was drowning in its own success. America was industrializing at a pace nobody had ever seen before, and the US economy was outgrowing the exchange's ability to process it. So the New York Stock Exchange needed a solution that matched the speed and complexity of this new era. They of course didn't have computers yet, so they invented something else. Well, someone else. The specialist. The specialist was a designated operator for a single stock, which means every single stock had a specialist, and every specialist held a leather-bound ledger known simply as the book. This book held every order for that stock, and I mean every order. So here's how it all worked. The heart of the New York Stock Exchange still took place in the same marble building that you picture today, but the floor was filled with trading posts that belonged to individual stocks where their specialists stood. A trade at a stock's post happened when a broker walked up to the specialist with an order. The specialist glances at the book and compares what was written with the flow happening in front of them and decides whether buyers and sellers actually lined up. And if they did, the specialist would announce the trade. 48 and a quarter traded! Then the clerk standing next to them would immediately punch that price into the ticker. The ticker was a machine that printed a continuous strip of narrow paper called ticker tape. Every transaction the specialist approved, including the price and the share count, was transmitted physically across the country and printed in brokerage offices and newsrooms. And now you know where the term ticker came from. And while all of this was happening in New York, the rest of the country was also trading. Customers in Chicago, San Francisco, and Dallas would walk into their local brokerage office, place an order, and that order would be wired or phoned into the New York Stock Exchange. So the entire nation's trading funneled into the single physical space, and one person called the specialist standing at the center of all of it, holding the only complete picture of the market. But the part that still surprises people is what happened when the book revealed an imbalance. If a wave of sell orders hit the book and there wasn't enough buyers, the specialist couldn't just shrug and let the stock fall into a black hole. Their job was to keep the market fair and orderly, which meant stepping in and buying the shares themselves with their firm's capital to slow the decline. And the same was true in reverse. So the specialists made trading possible, and at times they were heroes, but of course not everyone had pure intentions. Just ask Richard Whitney. Whitney wasn't just any specialist. He was the specialist, the most respected figure on the New York Stock Exchange who eventually became its president. On the floor, his word carried weight and his judgment was treated as fact. During the 1929 crash, Whitney performed what looked like an act of heroism. As panic spread through the room, he confidently walked to the trading post for U.S. Steel and shouted out an order to buy 10,000 shares at a price above the market. It was a theatrical move, a signal to the world that someone powerful believed the market was still worth saving. But it was all a show. Behind the scenes, Whitney's personal finances were falling apart. His lifestyle was too big, his investments were too risky, and the trust people placed in him became something he was quietly exploiting. At first he borrowed money, then he borrowed more. Then when the loan stopped, he crossed the line specialists were never supposed to cross. He started taking customer securities, assets that weren't his, and using them as collateral for his own debts. He stole from the New York Yacht Club, and he even stole from the New York Stock Exchange gratuity fund, which was meant to support the families of deceased traders. He wrote bad checks, and he lied to banks, and he kept going because the entire system was built on the belief that a man like Richard Whitney simply wouldn't do that. In 1938, the illusion shattered. Auditors uncovered the missing funds, reporters swarmed the story, and the president of the New York Stock Exchange was arrested inside the very building that he used to command. And for the first time, the public saw the truth. Even the most powerful specialist on Wall Street could abuse the power the system gave him. So this world wasn't meant to last forever, especially when technology eventually caught up and the foundation the specialist role depended on began to shift under their feet. It started quietly in the 1970s when computers finally became powerful enough to do something Wall Street had never been able to do before: connect buyers and sellers electronically without a human in the middle. These systems were called Electronic Communication Networks, ECNs for short. They were first built for large institutions that hated revealing their intentions to a specialist. Then in the 1980s and the 1990s, new ECNs appeared and brokerages connected to their systems. And when the order book became electronic, quotes became transparent, and trades happened in milliseconds, specialists weren't needed. So for 150 years, specialists stabilized the American American stock market. They were imperfect, they were powerful, and they were essential. But eventually, the world moved faster than any human could. And when machines stepped into the role, the modern market was born. Like, subscribe, follow @TheMagnificent on Instagram and X, and let's keep the education going every Sunday at 11 a.m. Central.